Welcome back to More Fun with Finance. I'm Dr. William Elliott, coming to you from my beautiful uptown Shaker Heights studio here, and on a beautiful sunny day, one of the unusual days here in winter. I've got Cheyenne. You can probably hear her walking around in the background, but hopefully she won't interrupt our lecture today. So, this lecture is all about how a company pays out excess cash. In particular, we're going to be talking about things like dividends and repurchases, but we're also going to add in there discussion about stock dividends as well as stock splits. So let's get on with that, and I will get out of your way here. So here's a basic outline of the chapter. We're going to start with the different types of payouts, how a typical cash dividend works, how a repurchase works and the differences between the two. Also, we'll talk a little bit about personal taxes, real-world factors favoring high dividend payout, the clientele effect, which basically says that firms may cater to a particular group of investors that desire to have a company that pays a dividend and others who desire not to have a dividend. So that's what creates this clientele. And then we'll wrap things up by talking a little bit about stock dividends and stock splits. And then I've got some of my own research on stock splits that I wanted to briefly share with you as well. So here we go. Different types of payouts. We can have cash dividends. That's the most typical. That's the thing that you're going to probably be most familiar with. These are regularly, usually quarterly payouts. And when we talk about how much the dividend is, we're usually talking about the dividend on an annual basis. So we'll add up the most recent 4-quarter payouts. Sometimes a firm will use dividends to pay back some excess cash that may have come from the sale of a division or a sale of some assets. They don't have anything else to do with the cash. That's more a better use than to give it back to the shareholders. So they may actually issue a special or some sort of extra cash dividend too, that is kind of setting it aside from the normal cash dividend. It's really important that they do that too, because if they change the normal cash dividend, they're pretty well locked into maintaining that at that level or higher. If they cut a dividend or if they altogether stop paying a dividend, the market reaction to that announcement is quite negative and quite drastic. Their share price usually plummets by double-digit percentages. Stock dividends, you might think they're the same thing, but basically they're just rearranging the chairs on the deck. A stock dividend is nothing more than handing out additional shares of stock, which the company has in its coffers, extra shares, and they just hand them out to you. They can be small stock dividends, like maybe 10%. So for every 100 shares, you would get an extra 10 shares. Well, problem is that the company's asset base didn't change one iota, nor has its EPS changed. As a result, what that means is that the overall price of the shares drops. Your aggregate value remains the same. It's just that it's spread over 110 shares instead of 100. But stock splits are quite frequently used. It's still a puzzle to those of us in academia who study this sort of thing and try to figure out, scratch our heads, why are they doing this? What's the point of this thing? Because it's a costly thing, and it's not unlike if you have $1 and you hand me the dollar and I hand you back 2 50-cent pieces. Has your wealth changed? No, not at all. The form has changed slightly. Now you have 2 things in your hands instead of just 1 bill. Probably a better example, since they're both bills, is you hand me a $10 bill, I hand you back 2 5s. That's really what a stock dividend and a stock split is. Both are simply giving shareholders more shares without asking for anything in return. And then finally, stock buybacks, or what are known as stock repurchases. those are much more like the first thing that we talked about, the cash dividends. And so they are a way for the firm to give cash back to shareholders. Now, a repurchase means that they're actually buying back their own shares. They're going out into the market in an open market repurchase. They're going out into the market and buying shares as anyone else would. And then they're just putting them into their treasury stock account. They're basically removing them from the marketplace. So we'll talk about all of these various types of payouts. First, with the cash dividend. There are a number of dates that are quite important to understand. Probably the most important date really is the announcement, or what's known as the declaration date. This, if there's any information to be gleaned from this by the market, that information presumably should get incorporated into the price on that date. Why would that be important? Well, suppose that we've got a stock that wasn't paying a dividend and they announced the start of a dividend. That's usually perceived as a good thing. That means that the stock has grown from a small startup and gone through its growth stage, probably is getting closer to mature stage, but is generating a large amount of cash flow. In fact, such a large amount of cash flow that they can't find enough positive NPV projects to use up all of that cash flow. So they're giving some of it back to shareholders who will then reinvest it elsewhere, or maybe even buy more shares of the stock. But that announcement, when that occurs, that's the point at which all of that information should go into the share price. If it's good news, if the market perceives it as good news, the price should go up. If the market already knew it was going to happen, price won't change. If the market didn't think anything bad was going to happen, but it perceived this as a bad outcome for the company, then the price could actually go down. It's all about what the market had as an expectation going before the announcement. Once the announcement is made, then expectations are changed. And it's that unexpected piece of it that is changing the price. Same thing with a dividend increase. Companies will announce, say they're paying a 10-cent dividend every quarter, and they decide to up that to 15 cents. That announcement is usually where the price will change. Then there are three other dates, in fact, that are of importance, at least for those that hold the stock or those that would like to get the dividend. And that is the ex-dividend date, the record date, and the pay date or the payment date. So the ex date is the day on which the stock is trading, and whoever buys it on that day, they will not get the dividend. All right. The record date is the date on which the company records who actually owns the shares on that day, and those folks, those investors, will get the dividend. And then the pay date, which is much later, is the date at which the dividend is actually paid out. Here on this timeline, it might make it a little bit easier for you to see this. So here is that announcement date right here, declaration date. You might wonder about why does the X date occur before the record date, right? Because I just said that the record date is the day on which the company looks at the shareholders of record and they say, all right, all of these shareholders, you are going to get a dividend. The next day is the X date. So why is this timeline reversed? Here's a little explanation for that. We have 2 business days for a trade to clear. In other words, you buy a stock, let's say you bought it on Wednesday. All right, that would be January 28th. So let's say this is Jan 28th. You bought that stock on Wednesday, and you continue to hold it. The trade, while you've agreed to the price and you've agreed to buy it, you don't actually get those shares. The trade isn't actually completed until 2 days later, and that would be this Friday, January 30th. On that day, then you are a shareholder of record. And so you would get the dividend. Now, if you bought that stock on the 28th and then immediately turned around and sold it on the 29th, that individual who bought it is not going to get the dividend. And the reason is that they don't really become a shareholder until Monday. They don't become a shareholder of record until Monday. They agree to the price and they agree to buy it from you, but the trade doesn't actually complete until Monday. This is kind of a holdover from the days when we didn't have the electronic computing power and the ability to communicate in milliseconds that we have today. But that's still the case. So that's why this record date is the day after the X date. It's actually those who owned the shares on the day before the X date, but they don't actually officially own those shares until 2 days later. You can, if you want another more maybe relatable analogy, think about buying a house. Let's assume that the contract that you signed to purchase the house, the purchase contract, is binding for whatever reason. You don't actually own the house, though, until the closing. And oftentimes that comes 2 weeks, 4 weeks, even 5 or 6 weeks after you have signed an agreement to buy the house. All right, that is the purchase contract. Well, this is the same thing, except that we just have 2 business days in between the agreement and then the actual execution of the trade. So that's the X date and the record date. And then finally, at some point later on, and it could be a month actually, then the firm actually pays that dividend to all the record shareholders of record as of this day right here. In this case, Jan 30. All right, hopefully that helps clarify some of those dates for you. Price behavior. This is another interesting thing to think about here. On the X date, whoever buys those shares is buying a company that has given out a fair amount of cash to the shareholders that owned the shares yesterday, day before the X date. So if we have, say, a company that has a value of $100 and it pays out $10 in dividends, that means the company's value is now only $90. So that price drop would occur on the X date. All right. Now, in this case, the value of the firm would drop from $100 to $90. If we wanted to do this on shares, let's say we had 100 shares, so they each had a value of $1, and then the company agrees to pay out 10 cents on every share as a dividend. That means that now as a shareholder, you now have a share of stock that's worth 90 cents and 10 cents of cash. Now, when you sell that share of stock on the X date, now that share is only worth 90 cents. So there's that price drop of 10 cents right there. Taxes actually make this a little trickier because the price drop isn't an entire 10 cents. Basically, the price drop is the after-tax value of that dividend. Also note, as I've underlined already down here, that any new information, that is, does this dividend, is it an increase, is it a brand new dividend, so forth, that price change occurs on the announcement date. This is a different price change. This is kind of more of a mechanical thing. We've got $100 worth of value. We give $10 of that to the shareholders in the form of cash Now we have a company that's only worth $90. In the world of no taxes, dividends are basically irrelevant. It doesn't matter what we do with the dividends because they don't really mean anything. In a perfect world with no taxes, no asymmetric information, why would we ever have dividends unless a company just ran out of good ideas to invest in which case then they'd pay the cash back out, and it wouldn't change the value of the firm one iota. You'd still have that decrease on the X date, but you wouldn't have any announcement effects. The problem with this is that we do have taxes, we do have asymmetric information, and one of the ways of resolving some of that asymmetric information is to use a costly signal. So what is a costly signal? A costly signal is something that will, if I'm incorrectly signaling to the marketplace, it will hurt me. So how does a company signal that it has good prospects in the future? Well, one way to do that, I mean, the CEO could get up there and say, hey, the company's going to do great next year. Well, that's worth about as much as nothing, right? Every CEO is going to say that. How does the company credibly say that? Well, the CEO could continue and say, not only do we know the prospects are good, but we're going to back that up with a big increase in our cash dividend. Now all of a sudden that's costly, because if they're wrong, if earnings don't go up, all of a sudden they paid out a lot of cash, and maybe they'll start losing their income and won't be able to sustain that level of dividend and have to cut it at a later date, which will hurt the stock price. Or maybe they can't even pay out what they've promised already. So that's the sort of thing that we see with dividend policy, is that it's usually viewed as some sort of costly signal. Theory that dividend policy is actually irrelevant, at least if we live in a world where there are no taxes. That's key. Keep that in mind. So let's jump into an example, because I think the example will prove the point most easily. So here we have a stock, Bianca Inc., and it is currently worth $42. The company is about to pay a $2 cash dividend. Let me change the color of this marker here real quickly. All right, so we have an investor who owns 80 shares of Bianca and would actually prefer a $3 dividend for whatever reason. Maybe they are retired, and instead of selling stock, they'd actually prefer the $3 dividend. So they've got one way they could go is to sell this stock and buy a stock that's going to pay a higher percent dividend. But they could actually create that $3 dividend if they did sell some of their shares. Let's see how that's actually going to work and why dividends don't matter in a world where there are no taxes. Okay, so we've got two scenarios. Here we have a homemade dividend and a actual dividend of $3. Let's compare the two. If the firm did an actual dividend of $3, it would actually be paying out to this particular investor $240. That's $3 times the 80 shares that the investor has. Total cash, of course, would be $240. And then the price drop, and again, because we have no taxes, the price drop will be the full amount of the dividend. So ex-dividend, on the ex-dividend day and following, the shares would drop from 42 on the day before ex-dividend to 39 on the ex-dividend day. So the investor still has 80 shares, but now they're only worth $39 per share, so a total of $31.20. Which actually their total value is still $33.60. Sorry, in the way. All right, let's compare that to, let's leave it with the company just paying a $2 dividend, and let's have the investor actually create another dollar's worth of dividend by homemade dividends. So here is the $2 dividend. That's $2 times the 80 shares is at 160. Now, the shareholder is going to sell these additional shares after the dividend gets paid. All right. So it's a $2 dividend, no taxes. Started at 42, it's going to drop to 40. So in order to generate the additional $80 that he needs in order to actually have $3 per share, he would have to sell 2 shares of his stock. Those 2 shares would sell at $40 each, so that would generate $80. Total cash to the investor is $240, same as over here. And then at the end of this, the investor now has only 78 shares that are worth $40 per share, or again, just like in the other case, $31.20, and a total of $33.60. So we can see with this example that it's irrelevant. The company doesn't have to pay any dividends, and we could create homemade dividends by using this method. So here are the numbers again I already basically showed you this same thing, but this is in a different format, so I won't spend any time on that. All right, another thing to keep in mind is that dividends are not generating value for the firm, and it costs money to raise capital other ways. So the fact that if a company already has the capital, it should always use them to invest in positive NPV projects first before it considers paying out a dividend. It never makes sense to actually do these as a in lieu of a positive NPV project. All right, now let's turn our attention to stock repurchases. These have become much more popular in recent years, and for a good reason, actually. They certainly allow companies to be more flexible. It allows individuals who own the company's stock to either choose to take a capital gains or not. Payment of a dividend is across the board, so whether you want the dividend or not, you're going to have to take it. Dividends are taxable, and as a result, if you don't really need it, you're still going to have to pay the taxes on it rather than postponing the tax bill until years down the road. All right, types of repurchases. We have a wide array of types of repurchases. Probably the most prominent, though, is what's known as an open market repurchase. An open market repurchase is where the company works with its investment banker and they tell the investment banker, I'd like to buy back $1 billion worth of my stock, and have one of your brokers or several of your brokers interact in the market. If the price drops down to a certain point, that triggers a buy. If it gets above a certain level, we want to stop buying and go off and do it. And then the company withdraws. There's some very specific rules around this set by the SEC, but the basic idea is that this is what's known as an arm's length transaction, right? So they've given instructions to the brokerage house as to how they want these purchases to be made, and then they walk away. And they let the brokerage house manage that process. It's supposed to protect investors from any sort of price manipulation that could result from these open market repurchases. And then the brokerage house continues to buy until they've spent the entire $1 billion, and then the repurchase program ends. Another thing to know about open market repurchases is that they could set it up and then later on tell the brokerage house, no, we don't want to do any more. We want to stop here. Or never even set it up. They could announce it and never even do it. The data suggests that when firms do announce these things, they usually either complete it for the most part, or for the most part, don't even do it. or only do a very small amount. There's very few that go in between that. But open market repurchases are one of the most popular means of buying back stock. Cash tender offers are another method. And so here they actually go out to the shareholders of the company and they say, hey, we've got, let's see, we've got stocks selling for, what happened to my pencil here? All right, let's see if that should be working now. There we go. We've got stock that's selling for $30. And so we say, hey, we're going to offer you $33 to buy back one share for every 10 shares that you own. In other words, 10% if you choose to tender, right? This is about tendering your shares. It's not that it's tender or tough. It's they're giving those shares back to the company for $33 instead of the market price of $30. That has its benefits and issues. Certainly, it generally ends up costing the firm a little bit more, typically because they're paying a premium for the shares relative to the current market price. We'll talk about more of the advantages and disadvantages actually on a one-by-one basis here after I get through all of these. Transferable put rights are another means of doing this. This is not unlike the cash tender offer, except that if you don't want to tender, the transferable put right gives you the option to sell the right to tender to somebody else. So you can at least capture some of the gain related to this, some of that premium here that we have in that extra $3. Privately negotiated block repurchases. That's another means where the company will approach a large block holder, somebody who holds 5-10% of the shares, and say, hey, we'd like to buy a large chunk of your shares. Can we come to an agreement in terms of price? If that's at a discount to the current market price, then usually that works out pretty well for both parties, really. Remember, if that block holder did want to sell anyway, they'd probably not be able to get the current market price because their excess selling would more than likely drive down the price. Even if they spread it out over the course of days or weeks, these large blocks typically have an impact on the market. And so if they really did want to sell them, they could still take a little bit of a discount and the company could get a better deal and both would actually be better off. If it's at a premium, that becomes problematic, right? Because then we're not treating all shareholders equally. So usually these things are negotiated at a slight discount to the current market price to avoid that problem. Then we have exchange offers. So we might say, hey, give us some of your shares and we'll give you some preferred stock instead. That's another means of repurchasing that stock. Why preferred stock? Well, because preferred stock typically has a limit on the returns to that particular type of security. It's kind of thought of as a hybrid between bonds and equity, common equity, that is. And then finally, we have these things that are relatively newer invention called accelerated share repurchases. And we'll talk more about that in just a minute. All right. Advantages and disadvantages of open market repurchases. No premium over the market price. We're actually paying the market price. We've got a broker out there who is out there acting as a buyer of the stock. Holders who desire liquidity get cash. Well, what that means is that let's say that you want to sell your shares. Well, there's the normal market activity, but if we have a company who has a broker that's out there buying shares, that creates additional demand, buying demand. So price will not tend to drop as low if we're trying to sell. There's usually a counterparty that's there standing by to buy, at or above a certain price or within a range of prices. There's less market impact than a tender offer. Well, partly because we can do these open market purchases, we don't even have to announce them. Even if they do announce it, you don't know who you're trading with. You don't know when the brokerage house that's buying for the company is out there in the market actually buying. So there's usually there's oftentimes there's a positive market response to these things, at least on average there is. But after that, there's very little impact. Whereas if you do a tender offer at a premium to the market price, then that almost always drives up the price and creates some sort of arbitrage opportunity or potential for. Some of the disadvantages, we may end up buying at too high a price because of that excess demand that we're putting on the marketplace. So that's one of the negative things. And there's a risk that the market price can appreciate well beyond what we were expecting. As far as cash tender offers, it allows the firm to more easily or guarantee a repurchase. Targeted repurchases means that they're eliminating some of the you hold 35 shares of something. Let's clear all of those small numbers out. That will create incentive for those shareholders to tender their shares. It also gives those who want the liquidity the opportunity to do it, and those who don't have to sell, unlike a dividend that everybody gets. The problems, of course, as I mentioned before, it usually requires some sort of premium, and that can be substantial, 10 to 25% above market. So the company is paying a pretty penny to do this. There's higher transaction costs because the investment banker has to go through more regulatory issues, requires additional work on their part to do this. And then you have the problem of either over or under subscription. So that can be embarrassing if the firm is undersubscribed. Maybe they didn't offer enough of a premium. If they're oversubscribed, maybe it suggests that shareholders want to get rid of their shares for a relatively modest premium. So those issues become pertinent in that particular situation. A transferable put right removes some of the problems, in particular for those who don't wish to tender. In a tender offer, you're basically out of luck. You're giving up a potentially 10 to 25% immediate gain relative to the market price, or at least the previous market price. Whereas with the transferable put right, you actually get a right to sell the shares that you can sell to somebody else. And then you don't actually have to sell the shares. You make a gain on selling that right to sell the shares, though. Again, there are higher transaction costs in open market repurchases, and put rights are taxed at the rate of a dividend. They're treated as a dividend. So still, no matter what, even if you didn't want to sell, even if you didn't want the transferable put right, you're going to trigger some tax obligations. Privately negotiated blocks, they can often be purchased at a discount, as I mentioned before, because if the block holder actually is thinking about selling anyway, the price that they actually will get, even if they use algorithmic trading and try to spread that over a long period of time, they're more than likely going to put some downward pressure on the price. It also is less of an attention getter. So if that matters to the firm, then a negotiated block sale might be advantageous. The success of the program is dependent upon the location of the blocks, who owns them, are they willing to sell? And then this issue that I raised earlier about preferential treatment, especially if they're not sold at a discount, if they're sold at a premium, this could trigger, the worst case scenario would be lawsuits from other shareholders saying unfair treatment. And it's a good chance they could win on something of that nature. Exchange offers, again, typically we're exchanging common equity for preferred stock. This is advantageous potentially from a tax perspective. Again, higher transaction costs than open markets. That's why open market repurchases are so popular. And then the shareholders are offered a less liquid security typically because there are usually many less preferred shares and the markets are much thinner than the common stock markets. And then finally, this thing called accelerated share repurchases. This is probably not probably, it is the newest type of repurchase. It has some interesting characteristics in that what we do, instead of going out and telling a broker, hey, I want to repurchase $1 billion worth of shares, here's a minimum price, or here's a price that you should cut this part out. And then the next one, this last one, is accelerated share repurchases. It's an interesting type of repurchase. It's the newest form of a share repurchase, and it has some distinct advantages. The one that I think about immediately is that it's an immediate increase to EPS. Why is this? Well, let me explain briefly how an accelerated share repurchase occurs. So rather than having a broker go out and start buying back shares in the open market, that can take months to actually purchase all of the shares that a firm would like to repurchase. They're only allowed to purchase a limited number of shares on a daily basis. It's a fraction of the average daily trading in the prior few weeks. So it can be very slow. An accelerated share repurchase works like this. We have the company, and they want to buy back shares, so they go to a blockholder, and they borrow some shares. All right. And then they take that block of shares and they retire it. Then they go out into the marketplace and they start buying back those shares. So they're paying dollars and they're getting shares back. And then they replace the shares to the blockholder. Now, this part of the process here may take months. This initial borrowing and retirement of the shares can be done in a day. All right? And based upon the rules that that the SEC has laid out for this sort of activity, they can immediately recognize a reduction in the shares outstanding. That means my EPS goes up. Now, it's somewhat illusory in that, we have actually, we have removed shares from the marketplace, but they're not shares that are actively being traded, and eventually they're going to be bought back. But nevertheless, firms like this. They like to show that pop in EPS. So this has become fairly popular. Another thing that it does is it also guarantees that they're going to repurchase all of the amount that they have announced. And again, these things don't have to be announced, but they oftentimes are because the firm wants to try to get that little price pop as a result. On average, when they announce these things, there is a price increase, an announcement effect. Of course, that is also one of the disadvantages. It does lock the firm into actually doing this. And there are, again, relative to open market repurchases, there are higher transaction costs. So that can be a problem. All right, so let's look at this mechanism here with these transferable put rights at a little deeper level. So the way these things work and the reason that we have them as transferable rather than non-transferable is simply that if you're an investor and you have a low cost basis, and let me define what exactly I mean by that. So let's say the stock is currently selling for, I don't know, $60. All right. and you bought it maybe a year ago for $30. So you've got a really nice little return built in there. You've got a 100% return on your invested capital, which is great. You've got a $30 gain. Well, if you were to actually tender your share that you had purchased at 30, and now the company wants to buy back and they're willing to pay you 65 instead of 60, in order to get that extra $5, you've got to recognize a $30 tax bill. Or, well, not that's not the tax bill, that's the taxable gain though. And long-term cap gains 15%. So you're recognizing, what is that, $450 in taxes in order to capture a $5 premium above the current market price. That's as opposed to another investor who just bought the stock a couple of days ago at $58. They only have a $2 cap gain embedded. Now, again, since that would be a short-term cap gain, that's at their current marginal rate, so that could be higher, but still, in dollar terms, not a huge amount relative to the premium, the $5 premium that they'd be capturing here. Now, that premium also is taxed, but that's the same in both of these cases. So the idea of making this put right transferable allows those shareholders who have a big potential tax burden to trade that premium, and maybe they don't get the full $5. In fact, there's no doubt they wouldn't get the full $5, but they might be able to sell it for $3 and at least capture some of that gain, and still avoid having to take that big tax hit on the embedded cap gains that they have in their position. So I'm not going to spend a lot of time on this valuing part, but they're usually issued deeply in the money, meaning that they're worth exercising. If I have the right to sell something at $70 that is currently selling for $60, that's deeply in the money. That's $10 of gain right off the bat. Because they have a very short life, we're talking maybe a month, maybe less. They typically don't have much time value. In fact, that gets ignored. In other words, the value of these things is exactly equal to what you can buy the stock for and what the put right gives you the right to tender it to the company for. If we look at repurchases vis-a-vis dividends, let's take a look at the impact on the balance sheet, because it does change. It's different depending upon which one of these things we do. No matter the fact that we make the same amount of payment out to our shareholders, it does have an impact on the balance sheet. So let's start with, here we have a firm that has $150 in cash, $850 in other assets, and a total asset base of $1 million. It has no debt, so this is an all-equity firm, and so the equity makes up $1 million. There are 100,000 shares outstanding, so the price per share is $10,000 or $10. All right. Now, let's assume that they distribute this $100,000 as a cash dividend. How does that impact their balance sheet? All right. Well, obviously, cash goes down by $100,000. All right. And so the total asset value drops to $900,000. The equity value drops to $900,000, and the share price decreases to $9 on the ex-dividend date. If we do this, though, as a repurchase, cash still goes down by $100,000. The value of the firm still drops to $900,000, but the price of the shares remains at $10. The reason is that we have reduced the number of shares outstanding from 100,000 down to 90,000. Those have been repurchased with this $100,000 at $10 per share. So we've repurchased 10,000 shares. Again, just some of the advantages. It's more flexible for shareholders. They don't have to take the deal, whether it's in the open market or any of the other types of repurchases. It's not required that the shareholder participate. So if they don't want to gain, they don't have to recognize it at that point in time. It also tends to maintain a share price and might even drive up a share price. The goal is not to drive up a share price, but it should and can certainly maintain, kind of put a floor underneath the share price. It can also be viewed as a good investment for the firm, right? It's buying back its own shares. It's sending a signal that, hey, we think this is a good investment. Maybe it's even undervalued a bit. And then there can be tax benefits, especially for those shareholders who don't want to recognize any sort of gain or dividend. To get the dividend irrelevance, we need these three things to be true: no taxes, no transaction costs, and no uncertainty. Or we could also use no asymmetric information. In the U.S., though, when we do think about taxes, both cap gains and dividends are taxed at 15%, at least if they are qualified dividends. That has usually most of the differentiation between qualified and non-qualified is what's your holding period. If it's long enough, then they are qualified and considered taxable at 15%. If they're not, then they are non-qualified and they're taxable at your marginal rate. But this isn't a class on accounting or taxes, so I'm not going to go too far into that. However, since the cap gains can be deferred, dividends can't be. So we have to take the dividend. We take the tax hit now, whereas with the cap gain, we can defer that for years, and the present value, even if the tax burden in dollar amount is the same, the present value of that dollar payment is much lower. Here's just a diagram to help describe why it never makes sense for a firm to pay a dividend by issuing new stock to raise extra cash. You have investment bankers here who charge fairly substantial fees. You have a market investing in that seasoned equity offering and saying, well, gee, why are they doing this? Well, if it's perceived by the market that they don't have any good investments, they're just doing it to pay a cash dividend, that usually doesn't sit too well with investors. So they may not be willing to pay a very high price for those seasoned equity offerings, and it triggers all kinds of taxes. So this is a lose-lose situation. If a company wants to pay a dividend, it really needs to generate that cash organically through its operations. This just goes on to describe more of that rationale here. Actually, cancel, stop. Now, firms with sufficient cash have some choices to make, right? First off, remember, they need to take every positive NPV project they can. If they still have excess cash that they don't need for operations throughout the year, and remember, there is some level of cash that most firms need to operate throughout the year because typically revenues are not evenly spaced across the year. Think about a retailer, right? They make much of their money in the last quarter around the holidays. First quarter is usually quite bad. Second and third quarter are okay, and then they make their money in the fourth quarter. So they need some sort of level of cash. But if it's above that level, if it's excess cash, then invested in a positive NPV project. When you've run out of positive NPV projects, other things you could do other than pay a dividend, you could go out and acquire other firms. Now, again, you still want those acquisitions to be positive NPVs. That's a mixed bag. The research is mixed on whether M&A is actually always a positive NPV. Could it go out and invest that into other stocks or other fixed income instruments, or could use it to repurchase shares? As far as taxes and dividends go, a firm should not issue stock to pay a dividend. We already talked about that. Managers have an incentive to seek alternative uses for funds to reduce dividends. You can think of this as the idea of empire building. Why does a manager want to build an empire, even if they're investing in negative NPV projects? Well, maybe they can justify a higher compensation package as a result of that. And then finally, though personal taxes mitigate against the payment of dividends, these taxes are usually not sufficient to lead firms to eliminate dividends entirely. There is kind of this clientele effect, and we'll be talking about that just momentarily. Some of the reasons for dividends that people offer up is that it gives retirees current income. Well, they can get that just simply by selling some of the shares that they own, especially if there's a cap gain involved in that, because if they don't pay out the dividend, then the value of the firm is higher, and those who desire to sell can just simply sell. But oftentimes there's kind of a behavioral aspect in here that, oh, we'd rather just take a little bit of cash off and maintain that share base. It forces discipline on us, right? Instead of having to actively do something, we passively sit there and they're paying us a dividend. There's also the potential for tax arbitrage. Investors can create positions in high dividend yielding stocks that avoid some tax liabilities. This is all legal. So we're not talking about tax evasion, we're talking about tax avoidance and minimization. And then finally, high dividends can also kind of enforce good behavior on the part of management. In other words, if there's not any money left in the company, if I've got a new project, I'm a manager, and I say, hey, this is a really great project, I have to actually go out and raise additional capital. And then I have to justify why this is a good project to the entire public. If I have money that's in excess of what I need to operate and I'm not paying out a dividend, I could actually use that money for this project and never actually have to prove that it's truly a positive NPV project. So it enforces some discipline on managers. And this is known as agency costs. Now, the clientele effect, there's quite a bit of research that looks at this, and there's some tendency for the research to show that there does appear to be a bit of a clientele effect. Individuals in high income tax brackets prefer stocks that have very low dividend payouts or no dividend payouts. And at the other end of that spectrum are institutions that have tax exemption or tax deferment, or corporations that have some tax preferences. They're able to avoid taxes as well on stocks that pay dividends. So they're looking at high to medium high payout companies. As a result, there are more companies that do pay a dividend tend to have more investors out of these categories. Companies that don't pay a dividend or pay a very low yield tend to have more of these individuals as shareholders. And this creates that clientele effect. And that kind of forces that company to stay in that regime. If they want to shift to another regime, then they're actually more than likely going to lose some of the shareholders that they had. That base is going to change from one group to the other. What's the rest of the research show us about dividends? Well, we do know that corporations tend to smooth these things. By smoothing, what do I mean? Well, take Apple, for example. If you look at Apple's dividend over time, first off, they're paying a very, very small fraction of their earnings in any given year. So if we were to go look at Apple stock and their dividend history, which we can do right here, I've got it pulled up on the web. This is actually off of Apple's investor relations page, but it's available in multiple other locations. But back here, prior to 2012, they had a rather spotty history, and they actually had cut their dividend entirely. After 2012, though, then they went back to a much more consistent pattern. So here we are in 2014 at the bottom, 47 cents every quarter. Then the next year they bumped it up to 52, and then 57, and then 63, and then 73. You can see this very steady. If we looked at their earnings stream during this same period of time, we'd see a lot more volatility. Dividends clearly are much more stable because companies think about these things. They want to have a very predictable dividend. If they don't, shareholders take that as a signal that something is amiss in the company because this is a choice, right? As opposed to earnings per share, which is the result of a year's worth of operations, which may or may not have gone particularly well, and you've got variations in cost and things of that nature. The dividend is something that the board of directors says, this is what we're going to pay out. And again, as we continue here, actually we have a 4-for-1 stock split right here in August 31, and you'll notice that the post stock split, so in other words, you turn in 1 share and you get 4 shares back. You'll notice that the post-stock split is on a post-split share value. So in other words, think of that as a quarter of a share prior to the split. So a quarter of that share would be 20.5 cents. Still adds up to the 82 cents though. And then they bumped it up to 22 and 23 and 24, which is the most recent one that's going to be announced, actually was announced back on February 1, but we'll have a pay date of February 15th, date of record of February 12th. And in this case, because remember the date of record is the day after the X date, so the X date would have been the business day before February 12th. Or will be, rather, I should say. It's not we're not quite there as of this recording. Anyway, that gives you some idea of actual dividend practice. Companies do indeed smooth this. There's definitely fewer companies that are paying dividends than there have been in the past. Part of that is that, we've seen an increase in repurchase activity, which is another way of distributing cash, and one that companies are less hesitant to use because you can do a repurchase today and never even complete it, and nobody really worries about it. It doesn't have a great impact on the value of the stock per se. However, dividends, because they are typically regularly announced on a quarterly basis, if you miss one, then people notice, and they're assumed to provide additional information to the marketplace. Another thing to think about with dividends is, you should never pass up positive NPV projects in order to pay a dividend. That's not sensible. However, you don't want to issue stock to pay a dividend. If you did have both a positive NPV project and you were paying a regular dividend, the stock issue would be for that new project. You can actually identify in the issue what's the purpose of the of this particular issue, whether it's a bond or a stock. And when we kind of put the sum of our knowledge, the research that's been done on this topic is extensive. It numbers in the multiple hundreds, if not even thousands, of studies that have looked at various aspects of firms' payouts to their shareholders. Aggregate payouts are quite large. Dividends are concentrated among the larger firms that are more mature. Not a big surprise, because you don't want to have to cut it, right? And those larger, more mature firms are less likely to have a lot of positive NPV projects that they're going to be engaging in. And excuse me just a second, I got to click out of this little pop-up that jumped up there. Managers are reluctant to cut dividends, and we'll see that in this example right here. Here's an example of why they're hesitant to cut dividends. This is back in May of 2023, a company called Installed Building Products, ticker symbol IBP, and they announced a significant decrease in their dividend. Their price was at 122, and it dropped down, let me get out of the way here, around to 114 as a result of that single announcement. Lost around 7% of the value of the company, which is pretty dramatic. So companies are reluctant to do that because that is a regular occurrence. When companies do cut dividends, they see this dramatic price decrease. They're smoothed. Already talked about that with the Apple example. And stock prices react to unanticipated changes in dividends. So now Apple, we've actually anticipated that they're going to raise their dividend on a regular basis by a penny or two per share. If they stop doing that, that would actually be something that's unanticipated and would be a surprise to the market. It might be a signal that's a negative piece of information about the future expectations of Apple's cash flows. And then another piece of this that we know for sure, the magnitude of repurchases tends to be quite high, and it varies with transitory earnings. So in other words, if we have a really good earnings season, we'll pay out that excess by using a stock repurchase as opposed to a dividend. Some general guidelines. It's a good idea to pay out most of the free cash flow. That way we don't involve that agency problem between managers and shareholders, right? There's always this idea that managers are supposed to act in the best interest of shareholders, or i.e. act exactly as though they were shareholders, but they don't always have exactly the same incentives. One of the primary things is that managers' jobs are tied up, right? And if their jobs, if they take on too much risk and the company goes under, their jobs are gone. Shareholders don't really care. I mean, take on the risk that's appropriate for the level of business. So there's where the two could deviate. So it's a good thing to keep that cash down at a level that's necessary for operations, but not much higher than that. Certainly don't want to avoid positive NPV projects, because literally that's what creates the value of the company. Remember, the value of a company is simply the sum of its positive NPV projects. Don't initiate dividends until you know that you can probably continue to pay them for the rest of the life of the company. Because again, you don't want to cut them because of that signal that it sends to the marketplace. Set the current regular dividend at a consistent, long-run, sustainable level. Set it low enough that you avoid having to use too much external financing, because it does become expensive. And then use repurchases to distribute any excess cash that may be generated because of a particularly good earnings season. We already looked at this one. Your authors talk a little bit about how do we reinvest these dividends, and many companies will have what are known as DRIPs. That's a dividend reinvestment plan. So when a dividend does get paid out, if you don't need that cash and you rather leave it in the company, you can literally set it up as an automated thing where when that dividend gets paid out, it immediately, as soon as it hits your account, it goes back into buying shares of the company's stock. Now, you're still liable for the tax obligation. So it does generate a tax bill, but it does also make sure that you maintain your invested capital in there. And it also ultimately increases your percent ownership relative to other investors. Now we move into the stock dividends and stock splits. Now, the key difference between these and cash dividends and stock repurchases is that a stock dividend and a stock split are not distributions of cash to shareholders. They're simply distributions of more shares of stock. From a purely economic perspective, this should make absolutely zero difference to shareholders. Yet, we see thousands of companies engaging in stock dividends, issuing stock dividends and stock splits. And these are non-trivial activities in terms of expense. Companies pay millions of dollars to do this. Not only are there the fees that they pay their investment bank to engage in this process, but once those shares are issued, the exchanges typically charge fees to be listed on an exchange, and part of the listing fee is a function of how many shares outstanding you have. So as you increase the number of shares outstanding, you increase the exchange fees that you pay. So these have always been a puzzle to the economics world. In fact, at the very end of this, I've got a study that I did, I've worked on most recently, that looks at stock splits, and I'll talk more about that in just a minute. But basically, the two types, the stock dividend and stock split, very similar in that they both distribute shares of stock. The key differences between these two is how they're accounted for on the balance sheet of the company. And again, normally, from a purely economic sense, it wouldn't matter. From a sense of some of the legal regimes in various states, it could matter. All right, and we'll talk more about that in just a minute. So a stock dividend proportionately increases the number of shares each shareholder owns. So, for example, if we had a 10% stock dividend, we would increase the number of shares outstanding by 10%. So if you were a shareholder who owned 50 shares and the company announced a 10% stock dividend and you held on to your shares throughout that process, you would end up with 55 shares. And the overall size of the shares outstanding would also increase by that same 10% amount. Here's how they are accounted for on the balance sheet. All right. Stock dividends are accounted by moving capital from retained earnings into both the paid-in capital and the capital contributed in excess of par value. That first account is simply the par value account. Both of these together basically give you the total amount that the total number of shares they've issued times the value of those shares when they sold them. Here's why it matters. You might think, well, hey, retained earnings is also in the shareholder equity side of the balance sheet. So why does it matter? The reason that it matters is, let's think about what retained earnings represents. It is what's left over of net income after the company has paid out dividends or stock repurchases. That goes into retained earnings on the balance sheet, and it actually accumulates over time. right? So that retained earnings account, as long as the company is profitable and has a positive net income and isn't paying all of its earnings out as dividends or stock repurchases, that account balance is going to grow and grow over time. And you can kind of think of it in a very loose sense that that's the amount of the value of the firm that has been generated in the past that is sort of owed, and I put that in quotes, owed to shareholders. All right. So some state laws actually make that literal, and they say, the amount of cash dividends that you pay out cannot exceed the value that is in your retained earnings account, because that's what's owed to shareholders and no more, no less, right? So if you're reducing that by paying out a stock dividend, then you're constraining the firm in the future from paying out cash dividends. And this could be binding, for a firm that doesn't have a lot of retained earnings. It could be binding. And in fact, some of the research does find that in those states that have that requirement, a stock dividend does send some sort of a positive signal about the future prospects of the company. It's a positive signal because basically the company is effectively signaling to the marketplace, hey, we know that this is going to constrain us in the future if we weren't expecting to have higher net income in the future. But we are. We are expecting higher net income, so don't worry about it. That's the signal that is sent, and in many cases received. That causes the share price to bump up by a small amount. Oh, by the way, I should also underline, total common stockholders' equity remains unchanged. In other words, that part, the equity portion of the balance sheet, does not change. It's the accounts within that equity portion that change in values. They kind of swap things around. Okay, that's opposed to how a stock split works. Stock splits alter the par value of the shares. So remember that paid in, if we go back here, we've got that paid in capital account. That is par value of the shares times number of shares issued. All right. Par value is an old concept, and basically it dates back to the origin of stock companies, corporations. And the idea is that they wanted to give investors some confidence in the value of the stock that they were buying. This was kind of a newfangled thing, Hey, you're giving us a piece of paper. It gives us the right to what? Well, at worst, it's going to be worth par value. And many times back in that era, we're talking a couple of hundred years ago, par value would be $1 per share, which was a significant chunk of money. And basically, firms were saying, hey, look, no matter what, you've got $1 worth of value in this thing, no matter how bad things get. So it was looked at as kind of a guaranteed minimum value. That concept has persisted. And what we see actually today is that par values are many times are a fraction of a penny, or at most a penny or 10 cents or something, very nominal, de minimis value. But nevertheless, that paid in capital account is that par value times the number of shares. That equals some value. So if we have, let's say we had $1 par value and we had 100 shares, that would be $100 in the paid in capital account. Now, when we're doing a stock split, if we have those 100 shares before the stock split, and let's say we do a 2-for-1 stock split, now that becomes 200 shares. So how do we deal with that and not change the value of that paid in capital account? Well, here we go. Well, we change the par value. Par value goes from that $1 down to 50 cents. And then we still have the $100 total value of the paid-in capital account. Regardless of what kind of stock split we do, here in this example, it's a 3-for-2. So 3 new shares are issued for every 2 pre-split shares. So that causes a 50% increase. The example I just gave you is actually called a 2-for-1, which is actually the most popular factor to use. The second most popular is a 3-for-2, and then you have 3-for-2. 3-for-1s, 4-for-1s, 5-for-1s. All of those are much less frequently observed. Okay, so what is the financial impact? Apart from informational, there is no real change in value per se. Again, the example I mentioned earlier was, you give me a $10 bill and I give you back 2 5s. The value of your stake has not changed one iota. Is simply that you now have 2 bills in your hands instead of just one. Should also mention the price per share decrease here. When we do a split or even a stock dividend, the price per share drops in the marketplace. I'm not talking about on the balance sheet or the company's records. If we have a stock that is trading at $200 per share and we do a 2-for-1 split, now we have 2 shares and the value of each share post-split becomes $100. Now, there can be this informational effect which might add value, and that occurs actually in 75% of stock split announcements. The other 25, you might be surprised to know, actually are zero change in price, and some of them are negative changes in price. So a company announces a stock split, but their share price actually decreases upon that announcement. So not all stock splits appear to cause the market price to go up, but every stock split mechanically reduces that share price by the increment. So in other words, if you've got a 2-for-1, that's a doubling, so you divide the share price by 2. If you've got a 3-for-1, it's tripling the number of shares, so you divide the share price by 3, and that's your new market price. So here's an example of a $45 stock that we announce a 3-for-2 split, and so we divide by that. 3-for-2 inverse is 2/3, so we divide by, or we multiply by 2/3, and we end up with a post-split price of $30 per share for that particular stock. If we had a 10% stock dividend, then we would divide by 1.1, which means the $45 price would have dropped to just under $41, $40.91 actually, to be exact. After a stock dividend, the per share cash dividend is often unchanged. You'll notice that in Apple's case, when they did that 4-for-1, if they had left it unchanged, that would have increased their dividend payout by 4 times. So it really is dependent upon the split factor. If it's relatively modest, like a 3-for-2, or if it's a stock dividend, sure, we'll leave the dividend on a per share basis the same as it was pre-split. That causes us to pay out more cash, and possibly, depending on earnings, it might be a higher payout ratio, but hopefully it's not going to hurt the company. Obviously, the company is going to look at this ahead of time and make a decision. But oftentimes you see, especially on the smaller splits or the stock dividends, which are by definition, the small stock dividends are smaller, they will leave it the same. Popular rationale for stock splits is that they readjust that price into kind of a habitat that is amenable to the clientele of that particular stock. There are a number of other reasons. There are some tax rationales for this. Most of these have changed over time. This theory was developed back at least 40 years back, and at that time there were very high commission rates, and the ability for individuals to own stock was much more. It was much more difficult for individuals to own stock at that time. We didn't have as many mutual funds. We certainly at that time did not even have ETFs. So stock prices did matter more. And so companies would keep their prices in that $30 to $50 range. And if it pushed up towards 100, you would see them doing 2-for-1 or even 3-for-1 splits to bring it back down to, say, $50 or $33. And some companies that were growing would do that almost on a regular basis. I recall a number of companies I followed when I was much younger is that they would run up to 100 and do a 2-for-1 back to 50 and run back up to 100 and do a 2-for-1. And by the time you got done, you'd own thousands of shares of the stock, even if you only started off with a single round lot. The rationale that we want to keep it in this sweet range, a sweet spot, is that you want to increase the breadth of your shareholder base. Why is shareholder base important? Well, it's important because there's, again, back to some theory. There's a theory out there that suggests the broader my shareholder base, the lower my cost of capital. Makes a lot of sense. I mean, especially at the extremes. If I have a very small shareholder base, company that only a few people know about and only a few people are invested in, then there aren't that many people to trade with. And so as a result, that the liquidity effect causes my cost of capital to be higher. As I increase that base, then there are more people to trade with, and the liquidity of the stock actually goes up, and the cost of that, sorry, let me rephrase that. The liquidity effect reduces the cost of capital. And so the broader my shareholder base, the lower the cost of capital. And by having a low cost of capital, I also have reduced the number of projects that I have to reject, because the lower the cost of capital, the higher my present value of future projects and the higher the NPV. So it's something that shareholders and companies are very interested in. Now, I mentioned a study that I've recently done here that relates to this. This actually is looking at authorized shares as opposed to shares outstanding. Let me briefly lay out the framework for this study. Authorized shares are the maximum number of shares that a company is allowed to issue by its corporate charter. So at the time a company incorporates, they write up this charter, and part of that charter says that you can only issue up to, but no more than, let's say, 1 billion shares. All right. This is by law required that they indicate some number in there. And oftentimes companies, what they will do is they'll actually pick a number that's 3 to 4 times more than they want to issue in their initial public offering. So let's say that the company wants to have 300 million shares outstanding, then that billion shares of authorized is about right. So they could issue another 700 million shares before they'd run out of authorized shares. Now, the corporate charter can be changed, but is usually a very difficult and fairly expensive operation. That is, typically they have to get a supermajority of shareholders to vote in favor of increasing it, and it takes months usually to do this. They typically will call a special meeting and then explain to the shareholders why they want additional shares and so forth. Not all of them actually are met with a positive vote. So there are some companies that have tried to increase their authorized shares and have been met with a negative shareholder vote. All right. Now, what do you do with these excess shares? Well, it basically gives management a great deal of latitude to do things without going back to shareholders. So you can kind of think about this as a power dynamic between management on the one hand and shareholders on the other hand. And as we have more what I call excess shares, that is authorized but not issued, management gains the upper hand because they can do whatever. They can do a merger, they can do an anti-takeover, several types of actions that will prevent a takeover, like poison pills, require a lot of excess shares. They can also do pro-takeover measures, something like a top-up option, which also requires a great deal of excess authorized shares. That gives management that power. As the amount of excess shares decreases, the power shifts back into the shareholders' hands, because if management wants to do any of these activities that require a lot of excess shares, they have to go back to the shareholders. And that can be easiest to see by this visual here, where down here we've got the excess ratio, how many times more authorized shares we have than what are currently outstanding. And then we have dollar costs over here on the y-axis. And if you think of the agency costs going up as we increase excess ratio, in other words, management's got the upper hand here because they can do whatever they want to without going back to shareholders and getting their approval. And then as excess ratio moves towards zero, or just the amount outstanding, the transaction costs go up. Because if management wants to do something that is in favor of shareholders, that is value creating for shareholders, then they may not have sufficient shares and they'll have to go back, and it'll take time, it'll cost money. Not only that, but there may be some sort of time-sensitive project that if they don't have those shares ready to go right now, they miss the opportunity. And we factor that into this transaction cost measure as well. At some point, you see a minimum where these two, this top line is the sum of these two costs. And so we think of this as kind of the optimal level of excess shares. Now, let me wrap this up, because this the next table right here really is kind of the most important part of this project. What we've done here is we've looked at, I think we have 594 stock splits. And we look at the price reaction to the announcement of the stock splits. And we calculate an abnormal return, or actually what we call a cumulative abnormal return, CAR, C-A-R. Basically, we're taking the actual return and subtracting from it what we would expect to get given the level of risk of that stock. We use CAPM, or just a market, the market return. But nevertheless, that's the measure that we're calculating. We do a 0, a 0 to 1, a -1 to 1, and a -2 to +2 period. So these are the length of the windows. These latter two, it's a 3-day window, and the last one is a 5-day window around the announcement. So day 0 is the day of the announcement. Day -2 would be 2 days before. Day +2 would be 2 days after. And given when these things are announced, sometimes they get announced after the market closes, so you don't really pick it up. Other times there's some sort of leakage of information, so it's not unusual that some of the information starts coming out a day -1 or day -2 and extends possibly in some cases to day +1 or +2. So usually those are the two that we prefer to look at. Now, the other thing we've done is we have sorted our sample by excess by excess ratio. So those stocks with the very highest excess ratio are at the top of the list. And then as we go down the list, we go to lower and lower and lower excess ratios. So we've sorted it from high to low, and then we've broken it up into 4 equal size groups, quartiles. So this quartile 1, that is the firms that have the very highest excess ratio. And this is up in the area of 8 to 10 times the shares outstanding. So these managers can do virtually any sort of action without going back to shareholders. It gives them a great deal of power. And then we look at the cumulative abnormal return on the announcement of a stock split. Remember, the stocks, one thing I didn't mention at the outset, a stock split actually reduces the amount of excess shares. It reduces the excess ratio. In my example, where we have $1 billion authorized and 300 million issued, and we do a 2-for-1 split, we would then have 600 million issued and only 400 million left for management to use. So it can substantially decrease the excess shares in the excess ratio. Now, if we look at the last 2 rows here are the 3-day and the 5-day CARs. And if you look at that Q1, the return, the abnormal return, the cumulative abnormal return is 4.25 in the case of the 3-day, and it's almost 5% in the case of the 5-day. Now, if we compare that to the lower quartile, those with the lowest excess ratio, and that can be on the order of just above 1 to 2 or 3, somewhere in that range, and we look at the cumulative abnormal return on the announcement day, we get 2.3%, 2.4%. All of these figures are statistically different from 0, and they're statistically different from each other. In other words, these 2 are different, and these 2 are different from each other. All right? What that tells us, or the way we interpret it, I should say, is that companies that have really high excess ratios, when they do a split, that's reducing that excess ratio. And shareholders, apparently, or the market, perceives that as a very positive effect. In fact, they have about double the announcement return as opposed to those firms that already have a relatively modest or low excess ratio. So that's kind of the takeaway to the paper. It's an interesting result and quite a strong result. So anyway, that wraps up our discussion of payouts, both stock and cash payouts, and both dividends, repurchases, and stock dividends and stock splits. Thank you.